Markets should brace themselves. A crisis with the Japanese yen is coming, and the results won't be pretty. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Interest rates around the world are setting the stage for several major crises, and the big headline one is the plunging yen. Japan is the world's third largest economy, and for decades the yen has been regarded as a major league currency, always classed alongside the dollar, the euro, the British pound, and China's yuan. But recently, the yen has shown serious weakness in foreign exchange markets. It has fallen 18% against the greenback to levels not seen for almost a quarter of a century. A few weeks ago, the Bank of Japan, the BOJ, indicated that the floor for the yen would be 125 against the dollar. That wall was quickly ruptured, and the new red line was 135, which has already been crossed. The benchmark that investors should focus on, the one that is considered sacred in Japan, is the interest rate on the country's 10-year government bond. For years, the ceiling on that interest rate has been 0.25%, 0.25%. A higher level would be damaging. The country's major banks and insurance companies are loaded with these bonds, not to mention other low-yielding or negative-yielding government paper. By far the biggest holder is the Bank of Japan itself, owning about half of the national debt, an astonishing proportion. To stave off disaster, the BOJ announced it is buying bonds by the tens of billions a week. Japan has long defied the laws of economic gravity. The nation's national debt is at levels once associated with deadbeat governments. Proportionately, it is twice the U.S.'s, and we're in no great shape. Japan's economy has long been stagnant. It is plagued with high taxes. The pace of government spending would make Joe Biden drool. How has Japan been able to float bonds with such absurdly low or non-existent yields given its conditions? First, yields haven't been a whole lot higher elsewhere, but that's changing now big time. Moreover, the country's bond market is rather unique. In essence, the handful of banks and insurers that dominate the country are brought together and told, here's what you're going to buy. The process is infinitely more subtle and polite than one would get from a Tony Soprano, but the result is the same. The bonds get bought at the suggested price. Now the reckoning is coming. Inflation is rising in the land of the rising sun. That sacrosanct 0.25% 10-year bond will likely be breached within a few months. This will trigger trouble for Japanese financial institutions as the value of their bonds fall. The falling yen will make Japan's exports cheaper, firing up pressure from competitors in other countries to have their currencies devalued in response. These devaluations will end up stoking inflation. The possible political and economic repercussions could be very ugly indeed. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.